PCE report just came out today, and here to discuss, Mr. Steve Frost. I want to talk about mortgage rates, Steve, and how this might impact that. But update the audience. What did we learn? How'd the number come out?
So the report that came out today, there are two of them, right? So there's a quarterly report and then a monthly report that came out. And so I'll touch on both of those, and hopefully everybody's still awake. At the end of that, we can kind of talk about some of the impact that has on the mortgage market. So the first report that came out, so the quarterly one is, I can't think of it. It's a report that measures wage growth. What was it?
Wage growth. Got it. Yeah, okay.
Wage growth. So ECI, I forget it's I can't think of the time. It'll come to me. But basically, when you listen to the Fed press conferences and Jerome Powell's out there, the one thing that we're really battling, because we hear this all the time, right? We're like, oh, we're going to be in a recession, and of course, all of our minds go back to 2008 and 9 when like car dealerships were folding and your neighbor was strategically defaulting on their house to buy the house next door to that one at half price. Got a foreclosure, not moving for 9 years. And like the problem with this is, and the problem that the Fed is having, the Fed's like, okay, we have to slow inflation down. So the PCE number we're going to talk about today, they want that to be 2%. But the problem is that that's going up, inflation is going up between like 4.5% and 5%. Well, so is wage growth. And so when people are, whether it be in the service industry or whether it be in the finance industry, whatever it is, when wage growth is growing at the same pace as inflation, guess what really doesn't impact people? There's prices, and so the Fed can't make companies pay you less. They can make it harder for companies to make money, but companies are not necessarily lowering people's wages. Now, you will see on some of the monthly job reports that we look at that the amount of hours worked are now below 40 hours, which if you look at that from like a wage growth perspective is kind of a canary in the coal mine. It's kind of like, oh man, like that's a huge number of income that we're taking away. But the Fed doesn't look at it like that. They're like, we're only looking at these old historic reports that are lagging indicators and all these things. So that number came out today, and it's showing that wages are still growing. And then we got personal consumption expenditures, or PCE. And so again, oh, thanks. There you go. So personal consumption expenditures, just so it's the simplest way to explain what this is how much money we're spending on our stuff. Like this is your credit card statement, right? And so when you're looking at this, we saw this number went up month over month. It went up 0.1%, but we're down 0.9% year over year, which is really good. Like that, like think about it. Like we were at inflation. Remember we were doing this and we had inflation at 9%. Then everybody's freaking out. So inflation's down 50% from the height, right? And that's what we call headline. And then if you look at the core inflation, we're down 0.1%. And that number, the core inflation is still at 4.7%. So that strips out food and energy prices because the government can't control those and whatever else. So either way, what matters with this is that these numbers were right in line with economic expectation, or what economists had expected them to be. And it's showing very clearly, even though the Fed won't admit it, like they're going to meet next week and they're going to raise rates a quarter point. Like it's a foregone conclusion that they're going to raise rates. But what they're doing is working.
Absolutely.
It's like the antibiotic is working, and like say you've got like some crazy blood infection and you start taking the antibiotic and you know that it's going to take, 36 to 48 hours or 72. I guess it's supposed to go 36, 40. I don't know, whatever. Like, it takes a while for those antibiotics to get rolling. And so they're starting to work what they're doing now. The criticism is that they're still pouring in the antibiotics, saying like, oh, it's been 12 minutes and it looks like the infection's still there, so we're going to keep it moving. So that's the part where we're going to start to see a lot more of these recessionary pressures.
Well, yeah, and thank you for that. And I think that a couple things to touch on is that wage growth being one that, to your point, hasn't slowed down, and then unemployment, right, is the other piece. And then when you look at the housing market as well, part of the hard thing for I think a lot of people to understand when it comes to economics and what the Fed is trying to do is to slow down the pace of spending so that these prices can come down. But housing prices, they just went up, right? the month over month, the year over year, the prices are going up, and so there's still a challenge. Wage growth is still going up. Unemployment is still, I think, not where the Fed
Very
wants
low.
it to be. Very, very
Totally low.
low. And so the Fed's saying, "Hey, man, this is working," but at the same point, we have to keep raising rates because of, to your point, wage growth and unemployment. Can you speak to that for a minute?
Yeah. So what the Fed's doing is it's not hurting people, right?
Right.
It's hurting
Exactly.
companies, right? So these companies, because the problem is there was like the great resignation, right? Remember that? Like we were
Oh
talking about that
yeah.
like 12 months ago. It's leaving jobs and companies were afraid of losing their really good employees. And
Yep.
so what's happening is the Fed is making companies very uncomfortable holding inventory. And we're seeing this. I mean, it's most obvious in the car market, right? Especially
Sure.
in like the more expensive car market. Like there are no $100,000 cars sitting on lots anymore. And that's because the car companies gotten wise to this. So like, we're not going to borrow this money to manufacture these vehicles to have them sit. Well, Nordstrom's doing the same thing. We're not going to buy, we're not going to order 5,000 pairs of Ferragamos at a time to have them sit in the back of our store until somebody comes and buys these $1,000 shoes. So these companies, that's what they're learning right now. That's what the pain is that these companies holding inventory right now, because remember, we went through very, very harsh time of shortages. So then these companies stockpiled everything. And they
Yeah.
do that all on credit. Like these companies aren't like when you go to like a Nordstrom or whatever store you go to and they've got the back, right? Like you go get another one in the back and like you go back there like that's all on credit. Like these
Yeah.
companies, like if you look at like a corporate tax return, it's line 17 on there. And it's like the revolving debt that these companies hold that's due within a year. And that's like how they turn over their inventory cost, right? And so that's all on credit. So that's what's hurting. These companies at the same time are still trying to retain they're good people. They don't want to get rid of them. So we are seeing wage growth. And the problem is that if you don't pay them enough, they're just going to go get a job somewhere else and get paid more. Now, I do think that that's the next. So we've seen the banking, right? So we've seen like the Silicon Valley Bank, we've seen First Republic Bank, probably see some more of these fringe banks suffer. That was kind of the first straw to break. I do think that the unemployment picture is it's just a very, very, very last indicator of an
Yeah.
economic recession. And we're just not there, but it's coming. Like
Yeah.
I know personally, I know people that have jobs who had a department of like 68 people and now there's four,
Yeah.
and they've let all of them go. And like I know other clients that have been looking at investment properties and stuff, and they're like, dude, I just got laid off from my job at a tech company. I can't, like, I don't know what I'm going to do right now.
Yeah. No,
So
that's
it's coming, you know.
absolutely. And I think that, so speak to maybe how you believe the report today will impact mortgage interest rates.
Good. So I'm again, try not to fall asleep, but going back to just the fundamentals, right? For anybody that hasn't watched us two goofballs and our big heads on here before, is that the reason that mortgage, the reason we're talking about interest rates so much and inflation in relation to that is because a mortgage is a 30-year loan. And what happens is you go to your bank, you go to Chase Bank, you go to National Mortgage Funding, you can go to Rocket Mortgage, wherever you go and you get your 30-year fixed with that loan is locked in and fixed at a rate. And then that is turned into a bond and it's sold on a secondary market. And it is held for a low yield, low risk return for a long term investment. Large pension funds will use these. Banks like Silicon Valley Bank will use these where they produce a smaller, like a nice return rather than having cash sit there and it's very low risk. So what happens is that if you're at a time when inflation is going up, especially at 9%, and you have all these bonds that are paying out 2 to 3% over a long-term low risk yield, they don't work. There's no liquidity, and you can't originate mortgages. So what do? They increase the yield on these notes as inflation is going up, and that way you get a bigger return on your investment when you cash it out a year or two later, and that just helps you not. You're actually not losing money because your money is being devalued by sitting during a time when the prices of goods are going up. And so interest rates follow inflation very closely. So as we see inflation come down, there is still the market for these securities or these long-term notes will still be very robust. These banks will want to get back into this market. There's always a place for them. So the lenders will then be able to use or be able to offer lower rates of return on those investments. And in turn, consumers will get lower rates on mortgage. So, all
No,
that being said,
yeah,
as we're starting to see these bonds or these inflation numbers come down, remember, we were on here in November and or was it like January? Whenever we were on here, rates were up around 7%. We said, hey, look, we're just 7.5, right? I mean, they're almost
yeah,
8. Like
yeah,
I was seeing rate sheets with like 8.25 on them, right?
yeah,
And so we kept saying, we're just waiting for CPI or consumer price index just to take the turn. And it did. And we saw rates really drop into like the high fives. And then they kind of went back up. We got some ugly employment numbers. And now we've started to see them come back down again. And May 10th is our next big employment number. So what's going to happen between now and then, right? And so today was a good day. Like mortgage rates got better by about 0.25% today. So you're talking between 6.25% and 6.5% on a mortgage, right? Standard 30-year loan. You'll find some stuff lower, you'll find some stuff higher. It depends on where you go, but you're in that range, right?
sure.
And so what we have coming, we've got to watch for the next jobs report. So that's going to tell us what our unemployment rate is, which the Fed is really watching. That's going to tell us hours worked and wages again. It'll give us another look at that. And then we're also going to get the Fed meeting next week, which a lot of people are going to talk about. They're going to raise rates 0.25%. The 6.25% to 6.5%, maybe less, maybe more rate that I'm telling you right now knows that. They're already planning on that. So when they raise rates, that's not going to raise that rate. That's already priced into that part of the market. So what happened today and what we see coming with some of the rental data and housing data that we're seeing coming out, where I do think that we're starting in continuing on that interest rate easing cycle, and it should be getting brighter as the summer goes.
Yeah, well said. And I think that the important thing for people in the real estate industry need to maybe understand is that all of this, when we talk about, bright days ahead, that might at the same time mean bad days ahead for the economy. That inverse is a very difficult thing for, I think, newer people to the real estate industry for them to understand. Can you speak to how mortgage rates respond, how the housing market responds during a time of a recession?
Yes. So especially this recession, right? So as the Fed is hiking rates to get people to quit spending money. So, right, we go back to, we were just talking about inflation and safe long-term investments, right? And we also talked about how companies are hurting. So what happens when companies are hurting, right? When revenues are down, when profits are down, especially if people start if we see people start losing their jobs or their wages stop growing, they stop buying goods from big companies. Well, what happens is a lot of that money that's in the stock market starts to leave the stock market, which turns that thing when you turn on CNBC in the morning, it's all red, it's a
Yeah,
big ocean of red. So as people start to leave that market, you still don't want, like, any financial planner will tell you, we have the same one. He'll tell you, like, the last thing this guy ever wants us to do is have cash. He's always like, give
that's
me all your
right.
cash.
Give me your cash. Yep.
They will move that money into a safer market, which is going to be like your mortgage-backed securities and your long-term treasury. So when there's more people wanting those bonds and those securities, there is less pressure on the issuers of those bonds to provide higher rates of return, which lowers mortgage rates for consumers. And the good thing about this time around, number one, is that the employment is still fairly robust, right? So now we're getting lower rates and we've got good employment. And then you look also at the fact that mortgage underwriting guidelines, they've already made the change. Like, we're not, like, the last recession was caused by the mortgage industry. This is not the case this time around. So you're not going to have these massive losses of values for your home. As a matter of fact, like we've seen many other times during a recession, is typically when you start to see values of these things go up, because again, they're safe long-term investments, and that's very, very recession friendly.
Yeah, and I think the best way to look at this is what we're showing on screen right now is that, again, Anybody that thinks that a recession is not coming maybe just doesn't understand economics 101. The Fed is essentially doing that on purpose. We said this a year and a half ago that it was a self-induced recession. Remember we talked about that?
Mm-hmm.
And the Fed is raising rates to do exactly that, which is to lower inflation, which by definition is slowing spending, which by definition is a recession. And as you can see on screen, after times of recession, going all the way back, right, into the late 50s, early 60s, all the way through the pandemic, every time there is some type of economic recession, what do mortgage rates do every time? They go down every single time. And so when we talk about bright days for the housing sector, for the housing market, for the mortgage business, for mortgage interest rates, what we see is that historically be the thing that pulls us out of the recession. It's like the hero during the recession. As the economy and the stock market's getting crushed, the housing market has got the light shining on it because mortgage interest rates are down, people are buying, people are transacting, and that's exactly what we see on that graph.
That same thing, I mean, as recently as 2020, that happened in the recession. If you remember, I mean, housing activity came to an absolute screeching halt, right?
That's
Remember,
right.
like we couldn't show
Yep.
homes. We couldn't. Remember, I was doing refinance closings with the notary and the people pulling up like this and then
Yeah.
changing documents
Drive
out their
through.
windows,
Yeah.
and it was crazy. But what happened to the housing market after that? It absolutely shot up. It skyrocketed. The same thing happened from 2012 to 2022, we saw the largest increase in property values ever,
That's right.
the fastest pace between that amount of time. And yeah, did the housing market cool off these last few months? Absolutely. We also had the highest mortgage rates that we've had in 20 plus years, and they
Yeah.
went from the lowest they've ever been to the highest in 20 years, the fastest they've ever gone up.
That's right.
So there is that. But then look what already happened. We saw last month there's 0.2% overall, right? On Case Shiller or something, we're
Yeah.
starting to see property values go back up. For everybody that's out there trying to bottom tick a value, a home purchase price, like welcome to the Thunderdome. That's where we are because, and as we know it, as interest rates start to drop and people that are in homes at 3.5%, like I have them now, like I have people that have been waiting for the last year. They're like, and I work with them all the time. They know the market. They're in this industry and they're like, we are not buying a house until interest rates start to go down. So I'm like, we're not going to move at 7%. We have 2.5 or whatever it is, 2.75 on our house. And they're like, look, Steve, we're bursting at the seams. If we can get pretty close to 6%, we're willing to make the move. They're listing their house this week and starting to head out in the market. So we're going to see, and you and I have talked about, I call it gridlock or rate lock, whatever it is. But once those people get close enough, because the rates aren't going back to 4, right? They're not going to go back to 3. Maybe we'll see like low 5s, but that's the big improvement that we plan on seeing. And I think once people realize that we're there, we'll start to see some of that inventory come back. We'll start to see people making some moves and seeing some of that stuff free up and give some opportunities for some people.
100% agree. As soon as that happens and we see rates kind of level off, a lot of people believe, 5.5% probably is the new norm. And now all the buyers and all the buyers or sellers that have been on the sideline that have seen rates over the last year be at 7.5, 7.75, at 5.25. Now they've got the perception, right? Now they have context. They can compare it and say, okay, I'm good now. And I think that a lot of people believe that the worst is behind us as it relates to the housing market, that in early 2024, the spring of 2024 probably looks like a really, really good, solid housing market once again. So listen, I appreciate it. There's a lot of stuff coming out here soon that we will continue to update the people on. But Steve, thanks as always.